welcome to the Capital Discussions Roundtable. Today is October 7th, 2015. And we have our special guest, John Locke, with us from LockeInYourSuccess.com. Before we get started, just a quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. You don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. So with that out of the way, John, you have a very similar disclaimer. So welcome back. It's been a couple of months, but always a pleasure to have you back with us, John.
Thank you, Tom, and again, I appreciate you, not just for myself, but for all the traders involved, having such a great forum here for traders. You know, Tom does an awful lot of work putting stuff together, so you guys have a place to chat with each other and learn a lot about trading, and you know, you should really appreciate that at a very low cost. So, great job, Tom.
Oh, thanks. So the goal is to improve everybody as a trader, so hopefully we're helping.
Right. So I think that's great. But awesome. So today I'm here to discuss high probability trading with high profit potential using the Bearish butterfly. And of course, we have this disclaimer information. But as we pass through that, for those of you who may be unfamiliar with me, I belong to a trading performance and coaching company called Locke in Your Success, LLC. And our mission is to inspire and assist clients or traders in creating happiness and financial abundance in their lives in the fastest and most effective way possible, utilizing success and trading principles that I learned and master. So in order to do that, I'm just going to show you some things that we have. We have multiple trading programs. I'll just quickly show you, what we've got going on. We have multiple trading programs, one-on-one and group coaching programs, and we have a really cool blog. We do a free webinar every Monday morning where we go over real-time trades from 4 of our more popular trading systems, and I encourage you to join that. And if you wanted to join that, you just simply go to my website at LockeInYourSuccess.com, go to freebies and more, and options trading for income weekly webinar. Then you can just sign up right there, and that way you can join us on Monday mornings. Also, another thing that I do is after this Monday morning webinar, I do a $1.5 million live trade that we cover at 10 a.m. Eastern with SNB Options Tribe. If you want to watch that, that is a premium service with those guys. But if you wanted to get involved with that, it's $30 a month, and you can sign up right here on the website. So I just figured I'd pick that out in case you want some free information or if you want to follow some live trades. All right, so moving on. Let me see if I can actually get out of this here. Moving on. Again, for those who don't know, go ahead. Is something, Tom, you were saying? Okay. All right. Again, for those of you who are unfamiliar, I am a retail options trader. I do trade using my own capital, so I'm not just a teacher and I don't just push programs. I'm an actual trader. I also develop options trading strategies and train and coach options traders on retail traders and professional traders. And again, I'm a professional trader on SMB's options desk as well. So, definitely a real trader here. So, so let's kind of move on. Let's talk a little bit about when I started learning income trading. That's close to about 10 years now. At the time, I didn't have millions of dollars to trade with. I had maybe $5,000, and I remember struggling with these baskets of 30 different income trades that people were advertising. And I did okay. I mean, I traded a few months, and I'd make money, and I'd trade a few more months, and I'd lose it, and then I'd make a little bit more money, then I'd lose more money again. And At the time, I was like I said, I was working on cars, and I pretty much working full time. Didn't have a ton of money, and I'm sitting there, I'm doing the math. My goal being, of course, to get out and be able to trade full time, or more specifically, to get out, get some time freedom, and be able to make some money without, having to go into work every day. So I'm sitting there doing the math, and I'm like, my goal here is to exit the car business and do something I really want to do, and not have to be on a schedule. And I'm thinking, in order to do that, I need to make about $4,000 a month. And I currently have $5,000 I can trade with. And I'm looking at the condors and calendars and all this other stuff, and I'm saying, even if this condor thing that all these guys are trading actually work as good as they say that it does, and I could reliably make maybe $30,000 a year, not $30,000, but 30% a year on average. If I could actually do that, if that was the case, I could probably trade for 20 years and still not have enough money to do what I want. And, the stuff they're teaching me at this time, I'm doing it, following their instructions, I'm doing all this stuff, and it's just not working for me. So I said there has to be a better way. And I went to work to create a somewhat neutral approach to the market that had a probability of winning that was similar to like one of those wide iron condors that they were doing at the time, yet had the potential to possibly win as much in 1 month than your typical income strategy might do in a year. And what I came up with is something that I, at the time, called an M9. This was back in like 2006. What I was trying to do is I was trying to take advantage of normal market cycles. The fact that the market typically runs up for a certain period of time and it runs down for a period of time. At the time I came into income trading. I was very new at trading, but I had done an awful lot with technical analysis. I'd done an awful lot with swing trading. And I was actually fairly good at it, but I don't know, something just pushed me into this market neutral stuff. So I wanted to take advantage of those cycles. And I wanted to mix swing trading concepts combined with income trading concepts so that we could take something that is only maybe a 30% a year thing to something that can make much more. So what I would do, or the idea or the concept I came up with, was to try and initiate a trade with a bearish bias position that's far from expiration in the middle of the price cycle. So I tend to look at the charts and I'd say, the market's, I'd look at the price cycle and say the market's climbing about halfway up its price cycle. Let's put this trade on. If it doesn't make it to the top, I make money. If it makes it to the top, it turns around, I make a lot of money. So my basic thing was expect the price to continue to rise and then simply do what it's been doing in the past cycles, where it goes up and it just comes back down and returns to the mean or the middle value, which is pretty much what we're doing anyway when we put a condor on or something. We're thinking the market's going to move away from where it is now and probably move back. So I'm doing the same thing. I'm trying to do it in a manner where at least we're capable of jacking up and making a ton of money. And then, of course, we use the income trading type of thing, that if the price moves too far, we move the tent. And I also like the swing trading aspect of I'm only likely to lose in one direction. So what I did is I went ahead and I tried to combine all these things together, and I came up with this thing called the M9 trade. Now, this trade is very similar to a bearish butterfly. However, it is definitely not the same. It's actually quite a bit different. It's extremely profitable on average, but it can be a very, very bumpy ride to get there. And what I'll do is I'll just show you an example of kind of what I did. And I'm going to do it in recent times, though. I'm going to do it in September of 2015. So, again, this is not a bearish butterfly, but it's very similar to it in that if you know what the bearish butterfly is, where you scale into the market, you start with a butterfly behind the market and you kind of scale in. So let me just kind of bring up option view here and drag it into the screen. All right, so this is Friday, July 24th. we have a September expiration. Usually I start these about 56 days to expiration. Back then when I was doing this, I wasn't so focused on the expiration. I was more focused on what's the charting doing. In other words, I'm looking for what's the normal cycle in the chart. So if I had a price chart, and I suppose I could bring one of those up too here. If I had a price chart, you know, for example, and I'm looking at my gains where I have something that goes up, you know, 80 points here, and then the next cycle's maybe 60, and the next one's maybe 100, and the next one's maybe 80. So I'm looking at those cycles and saying, well, how far up in the cycle am I? And when I get to the point in the cycle where I was probably probably about 40 points from where I thought the top was going to be, I'd go ahead and enter one of these. Let me get this down. I'd go ahead and enter one of these butterflies that was about 56 days to expiration. I normally wouldn't go closer than 45 or 50, and I probably wouldn't go much further than 80. But that was the concept there. I'm sorry, I saw a question come in and then it went away. But anyway, so I'd enter the market like this, and of course if I missed and I called the top in the market reverse right away, I have a profitable trade I could probably work with. But if the market did what I thought it was going to do and went up, I would add a butterfly a little bit higher, and then add another butterfly a little bit higher, and hopefully the market would reverse into the range. And if it didn't, then we would just continue to follow the market. And that was the basic concept behind what I was doing there. Now, back then, that was working extremely effective. But just to give you an idea of what something like that might look like, this, I did not use a price cycle on entry here. I just did 56 days to expiration, because that's what we do in the Bearish Butterfly course. And if I did enter this trade, I wouldn't have had to do anything until, actually, let me get my notes here. I wouldn't have had to do anything into this until the 20th of August. So if I go to the 19th, all right, so quite a bit of time. Nothing really happened. The market was just kind of swinging around back and forth. If I go to the 19th, we're just kind of sitting here. The position looks like this. The price didn't go up enough to actually have to add anything on. It didn't go down enough to have to do anything. Now, in this particular trade, I do have a reverse scaling. Now, what I mean by a reverse scaling is I add to the position when the market goes down. Now, in a Bearish Butterfly, we don't do that, but in an M9 trade, I often will. So this being 20 points below our short strikes here, what I'd do is I would come in and just throw another butterfly in here and move into something like this. Okay. Now, of course, the market kept going. On the 21st, I think we dropped almost another 20 points, right? So I reverse scaled in, double reverse scaling. And this is where the wild part starts, right? Here's the position we're sitting in now. And very high negative vega position, very high theta position. Typically, if the market stalls here, this gets up a lot of money right away. If the market does something wild, then you get drawn down quite a bit of money. But obviously, this case here, if you remember this Monday, this is the Monday that we had the mini flash crash. And this is going to have a substantial drawdown from that. So what we've got here is a situation where the markets just come all the way down to here. So you're dealing with regular income trading concepts. We moved the tent. I didn't do that at 1500. I did that at 1530, and this was actually showing down significantly, or actually double what it was showing down there. But what I did is I just rolled this position back all the way into here, so that my lower butterflies were at the money, or look right here. My lower butterflies were near at the money. We're just a little bit behind the short strikes, about 10 points. and then the bulk of my position is kind of in front of the market. Now, had the market continue to go down, we continue to go down with it, but that is what we would do with that. So from here, the market reversed fairly hard, but I'm just going to show you how quickly this gets its money back. You know, we had a $10,000 drawdown from here, and just as a reminder here too, if I come up to this here, I don't know, I didn't actually mention the risk parameters. Risk parameters on a trade like this are fairly high. I was running it at the time, right? Again, this is something I used to do. It's not necessarily I'd recommend you do today, but at the time I was running a maximum loss of 40%. I was, which was $2,000 for 5,000. So if you're looking at a $50,000 position, that's $20,000. Essentially didn't have a profit target. I basically stayed in it until I was uncomfortable with the risk, and that would be subjective to me. This trade has always been a wild ride, but it's always extremely profitable, and always, back in 2008 through the crash, when most income traders lost a lot of money, and a lot of people actually bankrupted themselves through that crash. I had a spectacular return. So that was great. So here, let me just go back down. If we move to like the 4th, right, this thing's already recovered and is up $6,500, right? So extremely fast recovery on this type of trade. And like I said, it's a wild ride. We were up, $5,000 or $6,000. We're down $10,000. We're up $6,000. Later on in the trade, we're probably going to be down again, right? So fairly wild ride trade. So here is this. If we go to the 9th. Right. So one of the things on this particular trade is I do have a maximum delta limit that I allow in the trade when the market's going up. And that maximum delta limit is minus 500 or minus 50 if it was a $5,000 position, but this is a $50,000. It's considered a $50,000 position, and I'm over my maximum delta limit. So from there, I would use my first default thing I would do on this particular situation would be to take my lower butterflies and actually roll them up to 1180. In general, I don't want to do that if my price isn't above this point here. If my price is not above the 1160s, and I take my 1120s and roll them to, say, 1180, that gives me too much downside risk. So rather than do that, I was looking for a delta correction and a low-cost delta correction. And usually what I do for that low-cost, low-risk is I simply add verticals in. Oh, actually, no. Hold on a second. Did I actually roll that? Actually, I did roll that. I was thinking of another spot. So at 1500. No, I didn't roll it. Hold on. I don't think I did anything here. Look at my T-log. I just had the date marked down, but apparently I didn't do anything there. No. I should have done something here. So what I should have done here is come in and done maybe 5 of these. Let me just go another half an hour. Or maybe it wasn't necessary a half an hour later. Okay, so it wasn't necessary a half an hour later. One of the things with this particular trade is I do not look at this intraday. I only look at it end of day. And since I was under my delta limit at end of day, I didn't really need to do anything. We will need to do something later. So let me move forward to this day. I just had the wrong day written down. So coming to this day, this makes more sense. I'm at minus 639. and I'm no ways near. I'm not past my short strikes. I don't want to do anything there as far as a roll goes. But what I will do is essentially do verticals here at 1140 and 1160 to flatten my delta out on the upside. And this is the new position that looks like. I had a question here. What were the delta limits on the M9 1/3, 2/3, and 3/3 enters? It's always plus or minus 500 regardless. So that's the only delta limit I had. If I was 2/3 in, it was plus or minus 500. If I was 3/3 in, and if I was 1/3 in, it was always the same thing. Okay, so that is where we ended up there. And moving forward here, this is almost done, by the way. Normally on a regular bearish butterfly, we're at profit target and we're out, but not on this particular trade. So one cool thing about this trade here is if the market stalls, that's not going to happen here. But if the market were to stall here and actually range somewhere reasonable, like between 1160 and maybe 1130, which is a nice 30-point range, you might be able to pull 30, 40, sometimes 45,000 or even more than 50 out of these, depending on how the scenario goes, which is really cool. All right. Of course, it is a wild ride, and like I said, you can lose money looking for money also. But anyway, nothing here. We go to the 15th. All right, we're all the way up to 1165. We are over our maximum delta number again. We are past our upper short strikes. So now it's time for a roll. So at this point, we would be looking at rolling our 1120 up to 1180. So if I run in here and I do that, right, so now 1120 is up in 1180. That gives us a position that essentially looks like that. And again, should the market stall, we're in a really nice place to take advantage of this going forward. And again, the market doesn't stall. It just continues to rise. And we go to the following day, which is 2 days before expiration. Right, we're up another $7. And what time did I do this? Oh, I did this at 1500. So let me actually back off a half an hour. We're actually up. Well, we were up over our limit at by 1530, and I ended up doing 10 more of these 1160, 1180s. If you back this out at 1530, let's go to 1530. If you back these out at 1530, you can see that we are over, definitely over our limit here. So let me just clear that out. Hit the wrong button. Clear my trades. Okay, so we clear that out, and if we go into the following day here, again, the market just continues to climb here. But this ended up being, a $23,000 trade. Earlier in the day, the market was actually up 17 points. This was way up here. So just this day, this would have fluctuated probably from being up around $10,000 or maybe even less, all the way back to 23. So it's just it's definitely a wild ride type of a trade. And like I said, sometimes these can, I really like the trade. Sometimes they can run over 100% gain, which is really cool. But it's a tough ride, and you do have a win-loss ratio, and when you lose, it hurts. But this is the basic approach I took to the market in 2006 through mid-2009, and it was just fantastic. Like I said, I was cleaning up when most people were just getting hammered. And that was until about 2009, right? 2009 comes along, and the first part of the year was great. The first 3 months were wonderful. But, come along March, and boom, the market goes straight up for 3 months in a row, right? We don't get any reversion to the mean. The market just keeps going and going and going. Now, luckily, when I was trading at that time, the M9 or this concept I was doing was still did okay. I wasn't making the 30 to 50+% a month I was making in the crash in early 2009, but I wasn't really making a ton of money either, and I contribute that to the fact that the volatility was very, very high at that point. In other words, we were in an environment where the volatility was sky high, and when the volatility is really, really high, something like this, it just does wonderful, right? The butterflies are really cheap. The adjustments you can make are efficient, and things just go along perfectly fine. But I also realized at the time, hey, if this type of a move had ever happened in a low volatility environment, I would have probably hit 3 months of max losses doing that in this particular format. So what I did is I came in and I added some delta theta rules. I was realizing that in low volatility, or when the market is wants to push in one direction or another, your T+0 line does certain things, and that being the case, I can kind of put in some delta theta ratio rules that will help me maybe trade a little bit differently in certain market environments. So I went ahead and I put those in there. And that helped a lot with this specific condition where the market just kind of goes up and goes up. So basically from late 2009 to probably 2011, or the next 2 years or so, I traded this utilizing delta theta rules along with the regular add-in points and the regular roll points and stuff like that. And I just had added that in there. Well, I did really, really well. And so well that I was noticed, and I was asked by SNB Capital, who trains day traders to trade on its prop desk, and I was asked by them to create a program on how to trade that way. So I thought about it for a while, and I almost didn't do it. And I said, yeah, sure, yeah, I'll create a program for you. And what I didn't realize at the time is this creates a whole series of challenges, right? Because I'm sitting here, and I'm going back over what I'm doing, and it's not really strict rule-based. I mean, I had a lot of guidelines and rules in place, but a lot of it was, looking at the market a little bit and taking some subjectivity in and things like that. And, I'm looking at putting together something that's relatively simple. That's what they want. Produces really high returns in a income format that is completely void of technicals, is very rule-based, and doesn't need constant monitoring, while at the same time doesn't get killed in strong uptrending markets, right? So I'm looking at that and say, well, that's quite a challenge to do. I have to put together something so that people actually understand how to do this type of thing. Well, I did that. I was up for the challenge, right? I did. Let's go back to the PowerPoint here. All right, so that was essentially the challenge that I had when I came in and had to actually make a program. I had to simplify it. I still had to maintain high returns while maintaining technicals. It had to be more resilient to uptrending markets. And I worked on things and worked on things. I came up with something that actually improved my win-loss ratio, but it did it at the expense of less profit, right? And that's how that came about. So when you look at the bearish butterfly, what we did is we basically took that situation and we kind of toned it down. We said, here are my risk parameters, right? I'm going to take a $5,000 planned capital position. I'm going to allow not a 40% max loss, but a 30% max loss. I'm going to actually put in a profit target of 30%. In other words, if I actually hit this number, I want to get out, because I don't want to get too close to expiration, because I know a lot of traders, especially new traders, are not going to be able to trade well on expiration. So I wanted to be out before expiration whenever possible. And because of that, if I was less than 21 days, less than 21 days to expiration, I'm not going to use a $1,500 profit target anymore. I'm going to cut it to $500 so that people get out of the trade and just move on to the next month where it's a little bit safer. So I came out with the program that did that, and that's essentially the bearish butterfly. And I think we got a question from Ray again here.
Yeah, yes. What year was that? The Delta Theta rules and SMB?
Oh, with SMB, I use this when I don't understand the question.
Oh, just what year did you start the Delta Theta rules?
It's late 2009. Late 2009, I started live trading the Delta Theta rules. So, all right. So let's move on. So anyway, and I'll answer more questions later. So anyway, we cut that down. We cut our profit targets down, and we just simply went into that. So let me go back to the same time period. Which I think is that day. And I'm just going to show you how much simpler actual bearish butterfly runs. So I go to 724. Albeit at the expense of less profits, but also it's a lot more mild of a trade. So here, if I go to 724, and let's see, just go into this other account. So this is going to be running bearish butterfly guidelines, which Delta Theta rules, we are going to apply Delta Theta rules, but there are several differences. In a bearish butterfly, or in the other trade, we scaled in backwards when the market went down. The bearish butterfly, we don't do that. Realistically, with a bearish butterfly trade, if you start 1/3 scaled in, you can take the market to zero and not lose money. If you're going to lose money on it, you're going to lose money on the reversal. You're not going to lose money on the way down, assuming you're only entered 1/3. When you enter 3/3, that can be a different story, but entered 1/3, that's the way that this basically goes. So what that does is it allows us to be a lot, to take down moves without drawing down. It allows us to, on the reversal, actually withstand a larger reversal and a faster reversal without getting hurt too bad. So if I was to go here and go all the way to the 20th, where we made the first adjustment on the other one, let me just go to the right date here. We'll just go to the 1430 for now. Right, this one here on the regular M9 trade, what I'd be doing is I'd be doing a reverse scale, and I'd be adding my 1180 butterflies in here when the market exceeded or went down to the 1180 level and actually increased my size. The bearish butterfly doesn't do that. If you look at where we are now, there's no real reason to actually do anything here. If the market stays the same, it's fine. If the market reverses, it's fine. If the market comes down a significant amount, it's still fine. So what we do instead with the bearish butterfly is we don't do anything here. We actually wait till the market gets all the way down under 1160, and then we essentially roll this back to somewhere that's close to at the money. So if we go to the following day, the market actually came down more, right? So we had a fairly hard down move from when we put this on. We even had a volatility increase, and we're in a position that looks like this, right? Very, very nice position. But this is typically when we're going to do a rollback point in a bearish butterfly, because we want to protect against further down moves. So what we would do is just simply come in here, and we would take this whole position and roll it back to near at the money. And since we're in the 1150s, we would basically do it at 1150. So that would be our new position here. I think we're even. And we go into a position like this. Of course, Monday, which I wasn't expecting, we had this crazy down move, right? And if we come into Monday, again, 45-point down move, drastic increase in volatility, all the way through the center of the butterfly, right? No problem. But again, we are at an adjustment point by the end of the day. Since we're in the 1100s, 1110s, right, the 11 teens, we're going to roll back to the 11 teens. And we just roll back to the 11 teens here, and or 1110 in this particular case, and we're back in this situation. Notice that we have less money in this trade than we did when we started. We started this trade, we had closer to $10,000 in it. Now we have around $5,000. And again, should the market had continued down in a crash situation, we come back to here, I'd sell this butterfly, I'd buy another one that's cheaper. Again, we come back to here, I'd buy another one that's cheaper. Eventually, you're actually above zero on your line. So, very, very effective as far as a downside protection type of a thing. Anyway, that's not what happened here. Of course, we had the big bounce. So let me go to just about 8:28. So from here, if the market reverses on a bearish butterfly, then we're just going to scale back into the position. So if I run to, let me just go here, just go to the 20, I think it's just the 28th. Actually, I'm already out. Let's go back to the 28th. If we come to the 28th, we had a really hard reversal. Right, notice now, though, we are 21 days to expiration. So initially when we started this trade, we actually had a profit target, or we're trying to hit, in this particular case, $15,000 profit. That didn't happen. The market took off in the other way. Now we're 21 days to expiration. We might still be able to make $15,000 in the trade. We don't know. But reality is, when we get closer to 21 days expiration, the trade becomes starts to become much more sensitive to price movement. So the concept behind the bearish butterfly is, hey, you get 21 days to expiration or earlier, you're up $5,000. At the end of the day, you get out. So that being the case, if we were up over 5,000, we'd get out. However, we're not up over 5,000. But we are past a roll point, an add point. So one of the things we do with this here, if I had a butterfly on, or I started a position at 1110, should the market go up 40 points over that to 1150, we add in the second third. So that's what we did here. And then from here, after we add the second third in, we're just in an exercise waiting to get out of this trade. This also does invoke some different delta theta rules, and as we come in closer to 21 days, we actually get a little bit tighter with our delta as things go along. But essentially here, we didn't need to do anything until the 1st, which is actually, I guess, the following day, right? No, 2 days later. Right, so the 1st, the market pulls back. Right, this thing's up in the up over our reduced profit target at the end of the day, and the trade goes off, and that would be the end of the trade because we're under 21 days to expiration. So those, and I'm doing this because I get asked an awful lot. What's the difference between an M9 and a bearish butterfly? And essentially, that's what it is. There's a lot of differences in the way that it's managed. The bearish butterfly, like I said, has been toned down to be easier to trade, be more rule-based, and not draw down as much as what maybe an M9 might draw down. And this is the way that I did it with this particular rule set. So it's a really interesting trade. It's something I really like. Are there any questions, Tom?
Just a couple. Let's see. So Robert asked, what was the reason for those strike adjustments? This is back when you had the first trade. It's a little while ago.
Right. So
I think it was the reduced delta.
right. So if we go to here, and I did the first delta reduction, I think at, let's look at my notes here. First delta 9/11. So let's just go to 9/11. So if we go to (9/11), I did this. The strikes were here, right? And this is what the position would have looked like pre-adjustment. I have a maximum delta limit on this particular trade of minus 500. And usually if I have minus 500, when I cut it back, I usually cut it back to around minus 250, which is half of maximum. And in this case here, I just bought 20 1140s, sold 20 1160s. This is something that we do to hedge bearish butterflies now. Sometimes, some of my students do that, using weekly options. It is an effective way to do it. You can buy and sell essentially equal time premium, so it gives me a delta shift for a very short range. And it helps, and you can do this on an M3 also, if a guy's straight M3, and it helps with the drawdown if the market should go up, and it doesn't hurt you too bad if it comes down most of the time. So that's a fairly effective way to do that. It's just kind of buy and sell, fairly similar time value, and it's kind of a neutral theta adjustment, neutral vega adjustment, but it does pop things out a little bit further, which is kind of helpful. So a lot of people do that, and they use weeklies. Back when I was doing this, of course you can't use a weekly here because we're only 7 days to expiration. Also, back when I was doing this, we didn't have weeklies. Weeklies was not an option, and they are. I don't necessarily recommend trading weeklies as an income trade, but they are nice options, or nice. They give you some flexibility as far as adjusting a little bit more efficiently if you're adjusting some of your monthly trades. Because essentially, short-term trading is more difficult than long-term trading, so just keep that in mind. When you try to decide to go to weeklies if you're not making money on monthlies. But anyway.
While we're here on September 11th, John asked, what was the margin requirement after that roll?
Well, that's a good question. We are going to have way too high a margin in a bearish butterfly or an M9 trade that goes bad. Or not necessarily goes bad, but in the event you get into close to expiration, triple scaled in, making delta adjustments, you will drastically exceed a $50,000, in this case it was a $50,000 plain capital trade. In those cases, you will get an excessive margin requirement. There are techniques to bring the margin down. So in this particular case here, we would be at, let's see, about 67, 68,000, which is too high. On the upside, we're only 27,000. This is very, very simple to fix, especially close to expiration. All you need to do is roll your lower longs up, right? So if I want to fix my margin requirement, now I don't usually go over this in demonstrations while I'm doing it because it starts getting way too confusing for people. But very minimal delta shift, very minimal very minimal theta difference, right? But it brought my margin down under where it had to be. So, as this market goes up or as we get closer to expiration, it becomes more and more efficient to roll in and take off your risk, which is something that we do live trading, but a lot of times, again, we won't do in demonstrations, especially with people who aren't familiar with the systems because they're confusing enough just trying to follow what's going on, never mind doing that. So yeah, so we had a high maintenance requirement there.
Okay, and Andrew asks, when you follow the market lower, do you try and keep the tent just above the price or on top of it?
Yeah, so when I'm following the, in this particular trade here, or on the bearish butterfly trade. The bearish butterfly trade, we're just rolling back to about at the money, whatever the closest strike is. In this particular trade here, usually what I'm going to do on an M9 if I'm going to reverse scale in is I'm going to wait till I get 20 points under my short strikes. So first adjustment on this one is going to be, let's see, 820. So let's just go to 820. Right, so this was 1/3 entered, and the market came down under 1180. So what it is, I just came in and I added a reverse scale in here. Doing this particular thing is like suicide in very bullish markets. I mean, you might as well take yourself and throw yourself under a bus, which is why the bearish butterfly guidelines, they don't do that anymore. They simply roll back. But if you're in a downtrending environment, or if you're in a sideways market, or something kind of like we are now, this is actually okay to do. It's not a problem. As a matter of fact, a lot of times, if you're in a downtrending market, doing this is very beneficial. It'll come down to this. You'll have a small bounce. You'll get a big gain in value. Then you'll come down a little lower. You get 3/3 scale. Then you'll get another bounce, and then you'll be up a bunch of money. And then all you do is just watch your delta for the rest of the trade and make a ton of money. But so it's very, very good in that market. In an uptrending market, this is very bad to do. So if you have something like 2013, for example, and you enter at the top of, at the top of one of those rallies, and the market reversed back down 20 points on your short strikes, and you added, then that was really, really bad. So, and I knew that, because I had traded this live for quite some time, and I'd been through that. So, knowing that ahead of time, then, when we came up with the Bearish Butterfly program, we said, you know what, there's just too much risk in doing this. Yeah, it's very helpful in a lot of markets, but there's just too much risk for the guy that's going to come in, doesn't really know much about technical analysis or anything. He just wants to, just put this quote-unquote income trade on the same way every single month. Doing this isn't a good idea. So, let's roll it back instead when it gets far enough back. And when things work out much better that way in uptrending markets, of course. But, like I said, there's pluses and minuses to doing everything. But like I said, this is effective in certain circumstances and not others. But that's essentially what we do. And then when the market came down to 1160, we added in the last third. So that's just called the reverse scaling.
Very good. Jack asked, how do you execute the butterfly rolls? Do you actually place butterfly orders, or do you use vertical spreads or something else?
It depends on the trade I'm doing. So in this bearish butterfly, the execution goes something like this. Particularly if I'm going to tell you the way that I do it, okay? In a bearish butterfly trade, I enter the trade when the market's screaming up. I know I want to enter the day near 56 days to expiration. One of the really weird things about butterflies is that when the market's moving a lot, this doesn't happen 100% of the time, but I'd say 85 to 90% of the time, when the market's screaming up, they collapse in value. So, say you had a butterfly that was $12, and in a market that's relatively flat, just the fact that the market just starts really moving, that same butterfly will drop to like $10. So, that being the case, I like to buy butterflies when the market is screaming up, and because they're a lot cheaper that way. That way, all that has to happen is the market has to stop, and I'm up a decent amount of money. Now, that's assuming that you're near your center strike or slightly above your center strike. That changes when you get way up near your long strike. When you get way up near your long strike, the dynamics are different. When you're up near your long strike, the butterfly has a better value when the market's screaming and a less value when the market stops. So knowing that, if I'm in 1/3 of a position and I get a day, what I'd like to do is I'd like to adjust up on a day when the market's really screaming. Because when the market's really screaming, yes, the butterfly I have got decimated from where I bought it. However, its relative value to where the price is right now is relatively high. Also, the butterfly I'm going into, its relative value is low. So that being the case, I'll typically buy, I'll roll on that type of a day. When the market's screaming up, I like to roll on that type of a day. So, so what I'll do is I'll usually buy and then sell. So I'll buy my next butterfly and then sell. Now, if I'm 2/3 entered, I run into a challenge because I might not have enough money to do that. I mean, if I'm really in a $5,000 account, I might run into something that where I have economic challenges, in which case I'll sell, then I'll buy to get into the last third. But usually the second third I buy, sell, and then the last third I sell, buy. And I usually do it when the market's screaming up. Because and this is good with M3 concepts too. You know, people say, well, the market's flying up today, so, and I went 10 points past my long strike or 20 points past my long strike on my M3 butterfly. So what I'm going to do is I'm going to wait a couple of days to see if to see maybe if I can get better pricing on my lower butterfly or something like that. But what they're missing out on is the fact that right now they're getting more than value than they should for that butterfly that got killed, and they're going to pay less than they have to for the butterfly they're moving into. Whereas if you let it sit, what happens is the butterfly you're moving into becomes more expensive, and the one you're coming out of becomes worth less, right? So you're getting killed on both ends there on the execution, right? So there's a whole art that lives within trading in general and adjusting and stuff like that. But to answer your question specifically on a bearish butterfly, usually if I'm 1/3 in, well, I'm not rolling. If I'm adding, I'll buy. Once I get 3/3 in and the market continues up and I have to roll, I'll drop out of the lower one and then try to buy the upper one. So, hopefully that answers that.
Yeah, a couple of comments just while you were talking about that. Robert says doing a bearish trade when screaming up is definitely counterintuitive. I remember you talking about like pushing a basketball underwater as far as the markets.
Yeah, right. If you in our APM program, right, we talk a lot about how the market tends to react, and it's you're right. Scaling in backwards, you better be in a downtrending market, because in an uptrending market, or we're still in a long-term uptrend, even though the markets have been down so much. We're in an intermediate-term downtrend, yeah, but the long-term we're still in an uptrend. But certainly uptrending markets, it's like that. It's like pushing a basketball into the water, and when it takes off the other way, it comes right back up to where it was again. So if you come in and you start scaling in backwards, which is what I did at the time. Hey, I didn't know anything about trading. I was just this guy that was, I didn't know a thing about a stock in 2005. If you asked me what a stock was or how to buy one, I couldn't have told you, right? I just came up with this M9 thing out of the fact that, if I was going to make this work, the things that the people in the professionals in the industry, the directions I was following, they simply weren't working. And even if they did work, they weren't going to give me enough money to get where I am today. So I said, you know what? I am going to come up with a way that I can make 100, 200% a year in a year, and parlay my money so that I can get to the point where I can actually go out, leave my job, make this, $4,000 a month, which was what we were basically living on at the time, and just move forward. And I did that. I would happen to be lucky that we had a market crash and we didn't have a 2013 type of market, right? If I had done that, we had a 2013 type of market, I would have had a real problem. But we didn't. We had 2007, we had 2008, and I just did fantastic through those times. Then mid-2009 comes along, and I'm like, uh-oh. I did okay, but I could see a problem here if we have another move up like that in the market, and it happens to be low volatility, it's going to be very problematic. So I came up with put these structures in place where I could take this and make it so that it would not hurt me so bad in a market like 2013. If you look at a bearish butterfly in 2013, I mean, it's a break-even trade by the guidelines. And some people think, oh, that's terrible, but here's the thing: every trade, no matter what you do, is going to have conditions where it does well and it does poorly. If you're out there looking for the golden bullet that does well all the time with this exact same rule set, I think you should go do something else because it's not there. So the better thing to do is identify when your trade's going to do well, when your trading is going to do poorly, and recognize that in the market and don't trade it when it's a problem, right? When it's going to be problematic. Or you can have some sort of a system where you adapt to the market. And when we go up into M21 trading system, that's a system that completely adapts to the market no matter what the market's doing. But as far as just finding one rule set that works all the time, it doesn't happen. And for me, for this bearish butterfly, by the rules to do like a break even if you traded it every month, 2013, even if it lost money, is fantastic. I mean, that was just an environment where the market just went up and up and up, and volatility was extremely low. I mean, even condor traders were, which typically tend to do okay in an uptrending, low volatility market. Even those guys were getting killed. So, to me, that's a really big win. And when if you look at our website results, to look at the fact, you get a 2012 that's in the 100% range plus, and you get a 2013 that's in the 2014 in the 100% range plus, and we're going to have probably a 2015 that's going to be in the 100% range plus. One flat year is not enough to discourage me from trading the system.
Well, John, we have more questions, but before we get to those, if people want to get more information and actually get the rules and guidelines, where would they go to do that?
Oh, okay. Yeah. SMB is actually going to do a special take because I'm talking with you guys. So they are doing a special offer, 5% discount on the Bearish Butterfly. You just go to bearishbutterfly.com. bearishbutterfly.com, and as a promo code is capital, CAPATIL, CAPITAL, and they said they'll do that till midnight tonight. If you're interested in something like that right away. If you just want more information on it, then you can run to my website, which is here. Oops, I guess that's not going to let me in there. All right. But anyway, lockeinyoursuccess.com, and you can just go ahead and do that. So that's how it's done.
Okay, great. So a couple more questions, and then we can wrap it up.
Sure.
Casey asked if the rut is up 80 or more points from its most recent low, would you use M9 rules instead of bearish butterfly rules when initiating a new trade?
Generally, if you don't know the M9 type of rules, then I would definitely stay with the bearish butterfly type of rules on the trade. In order to trade this into expiration, you're going to want to extensively backtest it. You're going to want to make sure you understand how to execute stuff right up into expiration week in a high gamma position, which it can be challenging. So I would basically stay with this. You're not going to run into delta theta issues with the market right now. So the regular bearish butterfly standard rules are fine. I wouldn't. One of the things about this time of year, you guys trading, if you look at the charts or if you've traded for a while, it's like 90% of the time, mid-November to January 1st is a very, very large up move. So you want to keep in mind that, that may not happen this year, we don't know, but historically, overwhelmingly, we have a very big up move, and combine that with the fact that the market's been down a lot, we might see the Russell at 1,300 again by the end of the year. So, that being the case, you need to keep that in mind and, stay with regular bearish butterfly guidelines if you're going to do a bearish butterfly. Once the first of the year comes, all bets are off. That's where the market goes, but usually the end of the year it goes up. So I would avoid reverse scaling in right now and stuff like that. I would wait till I would wait till maybe next year to do that.
Okay, another quick question is, do you look at the charts before putting a bearish butterfly on, or you just wait for the 45 days?
Oh yeah. Well, 56 days, and I, personally, I play by the charts. In other words, we have all these programs out here, but and again, they're all necessary in the progression of being a great income trader. But what I do is what we call M21 trades, where we analyze the market and we make a custom trading plan for the market. So, I do things like, one of the things people may or may not know is that these systems all go together. The M3, the bearish butterfly, the rock system, they all piece together into this whole dynamic on how to trade and adapt to the market. So what I'll do is I'll come in, and with the M21 system, we have a method of reading the market and seeing where it's most likely to go, and we'll custom design a trade plan around that. So we might be in a situation where we start in a bearish butterfly, and we switch over to an M3, and then we push into a rock trade, and then back into a bearish butterfly again, all within the same month. And that's the way that I personally trade. If I'm going to do a straight bearish butterfly in general, I'm going to want to do it when I think that the market has a top to it. In other words, when I have an idea of where I think the top of the market might be, I'm very, very interested in a bearish butterfly. If I'm within 60 points of a market top, and I can say that fairly confidently, then I'm definitely going in to do that. Now, if you have the skills to do that, that's great. Then you can do that too. If you don't have the skills to do that, then you're usually better off just not trying to time it, just trying to trading it every month. And as far as the bearish butterfly is concerned, if we happen to be in an extremely bullish market, being more careful with charting. Generally, with a bearish butterfly, if the market's volatile, you don't really have to pay a whole lot of attention to charting anyway, because you can usually withstand a 100-point run before you max loss out. But certainly in low volatility, that's not the case anymore. So you got to keep that in mind. But in general, for most people, I would say, just make sure you're not or I would avoid being at a support level on entry day in an uptrending market. Other than that, then I don't pay too much attention to it.
Okay, a couple more questions, and then we're done here. So Rich asked a couple that, so you don't add the 1/3 scale in below the market, you roll down in case of a reversal?
Yeah, I prefer to roll down and not scaling backwards nowadays. And I almost never scale in backwards anymore. I did do that like I said, I did do that earlier on in my career, but it's fairly risky, and you can get hammered to the upside.
Okay, and Rich's second question was, so for uptrending markets or fast reversing markets, you don't add your 1/3 scale in below the at-the-money butterfly, is that right?
Right, I don't.
Okay, and then Chuck said, when in a 1/3 bearish butterfly position and RUT moves up above 2 add points in a single day, move to 2/3 or 3/3 position or something else?
Okay, yeah, that's a good question, because that can happen, right? So you can enter a bearish butterfly and have a 40-point move up in the Russell in a day. Or maybe or it might even be something like this. You're in a bearish butterfly, the first day it goes up 20 points, not quite 20 points, you're just below your add point, the next day it goes like 30 or 40, which is rare, but it can happen. So in which case, I just close down the lower butterfly, and I figure out where I would have been had I done all the trades, and I open up that position, whatever it would have been, right? So if I went in backtester and I added another one and then had to roll and I had to roll again, then I would just take that whole position and just plop it right where it should be. That's how I generally handle that. If for some reason I had the feeling the market was going to continue to fly up, I might only go in 2/3 and try and ride out the rest of the rise 2/3 in, rather than going fully 3/3. But that's the way I'd handle it.
Okay. And MLS, is this only good for OptionView users? I know you're a big proponent of OptionView, and I use it.
Well, yeah. I mean, OptionView, if you're doing trades that are complex in nature, in other words, they're more than 2 strikes, and you're relying on the delta at the T+0 line and the way that the T+0 line looks, then OptionView is the only system that gives you, or let me put it this way, it gives you the best and most consistent representation of a T+0 line. If you're looking at TOS or ONE, as of right now, I know ONE is working on upgrading and getting this and getting it better, which I hope they do, because I would love to have another option other than OptionView. But as of right now, OptionView is the only one that's that consistent. In this environment, it's less important. In other words, when the volatility is up, ONE or TOS analytics are a lot better. But I mean, it's not just this system; it's anything that you're doing that is requiring or is counting on you doing T+0 line analysis. Like I said, in this environment, they tend to be more consistent because the skews straighten out. But if you get in a really low volatility environment like 2013, and you take a look at an OptionView analytics chart on the right settings, and and something else, you'll see there's a huge difference. And what I know from experience is that, and it's not just my systems. I coach, it's directional traders. I coach people who do condors and calendars and all kinds of things. What you get is a serious misrepresentation in those systems of what's going to happen to your price when the asset actually moves. And it's so bad that in 2013, and like I said, and before 2013 it wasn't that much of an issue, but in 2013 we were getting instances where people were losing trades that they thought that they were perfectly fine in. And you take a look at the graph and you say, hey, the market goes up 10 points, I don't have a problem. Well, the market goes up 10 points, and next thing you know, you're 3/4 of your way down to maximum loss, and it didn't show in the analytics anywhere. It showed in OptionView, but it didn't show in anything else. So, that being the case, OptionView is a much better choice for most people. Again, depending on how you're trading, as of right now. Like I said, I know ONE is working on doing something a little bit better. But if you're having trouble losing money that you don't think you should be losing, then you should probably look at that. Either you should probably consider maybe getting a different analytical software. And I do recommend OptionView for all the systems I have.
So quick question for you, John. We're over an hour. I don't know how much time you have. There's still a few more questions. Would you prefer that people send you the questions via email, or do you want to take a few minutes and do it now?
I have a few minutes, and I can answer questions. That's fine. And but then I have to get going in about 5. Okay? Okay.
So Rich asks, when you were talking about when the market's screaming up and it's a better price for the butterflies, he said, is that because the IV drop caused the lower butterfly to lose relative value more slowly than the upper butterfly?
You can look at it a lot of ways. The way I look at it is this. I look at where your price is supported. So, in other words, what is making the T+0 line where it is? Depending on where you are in relative to your butterfly, it depends on what's holding your value up. So, if you're in the center of your butterfly, your T+0 line stability, or where it sits, is primarily determined by the value of your short strikes. If you're way up by your long strike, or on top of your long strike or past your long strike, your T plus 0 line value is held up by that long option. Because what's happening there is the price is moving a lot. Whether volatility goes up or down, it doesn't really matter. The reality is the price is moving a lot. And if the price is moving a lot, the value in the option that's near the money is going to experience a value increase because that's what people are buying. And since people are buying them, they stack value into them. So that means if your long strike is like 10 points under where the price is or 20 points under where the price is, there's a lot of time value there. And as soon as the market stops and they have to pull that time value up because people start selling those options, then you get a collapse in the price. You get a collapse in value of the butterfly because that's what's holding your value up. And in the same context, if you're buying a butterfly 20 or 30 points under the money, there's a lot of value in the short strikes. And you have twice as many of those as you have with the long strikes, and that's depressing the value of the butterfly closer to the money. So it's just where you are relative to the strikes, and you can kind of determine what's holding your value up by your Vega number. Basically, if you're running a positive Vega number, you have long strikes holding your value of your T plus 0 line, and if you have the more negative Vega you have, the more negative or short options you have holding the value of your T plus 0 line. So I look at it that way, and knowing that and knowing the dynamics of the market, when the market really flies up, you're getting an extraordinary value for a butterfly way under the money. But when the market stops, that value is going to come out. And like I said, the value of the butterfly itself drops, even though your Vega is telling you, right, that's the biggest joke of all. Your Vega number, your composite Vega number. People look at that. That's a big joke. But your composite Vega number doesn't. That's what it's telling you. If your options are all in the same month, it's essentially letting you know what's holding your value in your position. Hopefully that makes sense.
Yep. And Marco asked, do you teach every trader on the desk at SMB?
Every trader on the desk at SMB uses my system, so I've either taught them through personally being with them, or through my training programs. So yes, because everybody right now is using the systems.
Okay. Marco also asked, does some of your students hedge the bearish butterfly with weekly options? Are there traders who hedge the M3 with weekly puts for risk on the downside?
Yeah, we have, I work with a lot of traders where we deal with weekly options, yeah. Weekly options allow you a lot of flexibility in doing things. And it also, in other words, also a lot of my M3 traders use weekly options for a call hedge rather than monthly options too. So it allows you to be in and keep the capital down. But there's some nuances to doing that. So I wouldn't just go and do it. But just keep in mind, you can trade a $50,000 M3 with like 20 grand or less, and keep the capital under that level if you want to. Realistically, the M3 within the program is terribly inefficient in its use of capital, but it's done that way for a reason. And I do think you should trade it that way, by the way, especially if you're new. But when you get more advanced, you can literally double your size pretty easily with the trade with the same amount of money. So pretty cool.
And we've gone more than 5 minutes, so I know you've got to get going. So there are more questions. If they do want to contact you, should they contact you via your support or email direct, or how would you like?
Yeah, you just go Locke in Your Success. You just go to my website, and it's john@lockeinyoursuccess.com. And you can give me questions, but give me time because I'm definitely backed up with questions. So, we'll get to you eventually if I can, as long as it's a simple question to answer. If it's a long, involved question, then I'll do my best to give you a short answer for it. But like I said, I do have to budget my time a little bit with emails. But certainly, yeah, if you have a quick question, send it over, and we'll do what we can. Okay.
Okay. Well, sorry we couldn't get to all the questions. There were quite a few, but thanks so much for your time, John. Really appreciate it, and a special offer too. If people want to invest in the bearish butterfly, they can get a little bit better price today.
Excellent. Thank you, everybody.
Thanks,
Thank
everyone.
you, John.
John.